I think there's a lot of downside risk in this market. I think the only chance the market has of recovering at some point during the year would be in the aftermath of a full-on Fed pivot, and I'm talking back to quantitative easing. Because as long as the Fed is doing quantitative tightening, even if it stops hiking rates, if it simply leaves them alone, I don't think that's going to be enough to stop the stock market from falling. But here's the problem. If Bitcoin is a risk asset, then what the hell is the value proposition of Bitcoin? I mean, who needs another risk asset? We got plenty of risk assets to choose from. Why Bitcoin?
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar. Before listening to him, please ensure to smash the like button and subscribe to the channel.
Today is any indication of how the markets are going to trade during 2023. We are in for a lot of volatility, but I think today was very telling as to how the rest of the year is likely to play out. First of all, the Dow Jones early in the morning was up better than 200 points before selling off intraday to down over 300 points before closing down just 11 points. So almost unchanged, but the other broader indexes were decisively weaker. The S&P surrendered early morning gains to close down 0.4%. Russell 2000 surrendered those gains and closed down 0.6%. And the big loser on the day, the Nasdaq, closing down 0.8% after early morning rally. And I think this pretty much is setting the tone for the way the stock market is going to play out in 2023. I think it's going to be another weak year for stocks, in particular for the stocks in the Nasdaq. In fact, take a look at some of the big names from 2022 and in fact from years past, and look at what happened to those stocks today. Apple Computer, one of the most highly owned stocks in the country, the second A in FANG, was down 3.85% on the day, hitting a new 52-week low. Apple is now down by 32% since its high in January of 2022. Also look at Tesla. It's not a FANG stock, but it was probably the first unofficial meme stock. A lot of people own Tesla. That stock was clobbered by 12.5% today, hitting a new 52-week low. It's now down 73% from its record high set in January of 2022. The market hit its highs last year in January, and it was downhill from there. And I think you're going to see the same thing again in 2023. The highs of the year are likely to be made in January. In fact, we may have already made the highs intraday today. We'll see. But I think there's a lot of downside risk in this market. I think the only chance the market has of recovering at some point during the year would be in the aftermath of a full-on Fed pivot, and I'm talking back to quantitative easing. Because as long as the Fed is doing quantitative tightening, even if it stops hiking rates, if it simply leaves them alone, I don't think that's going to be enough to stop the stock market from falling. In fact, if you listen to all the coverage on CNBC this morning, which I did, as the market opened for trading in a brand new year, most of the people were saying that this was likely to be a up year. And why? Because last year was a big down year. In fact, it was one of the worst years ever. I'll get into that in a moment. But because the market was so weak in 2022, historically, when you have a down year, it's followed by an up year. So everybody just assumes that history is going to repeat, and they have absolutely no conception of why the situation is very different now than it was following prior down years. First of all, yes, the stock market was down big in 2022. In fact, the S&P had its biggest annual decline since 2008. But it's not cheap. If you look at the PE of the S&P, even after a near 20% decline in 2022, it's still trading at around 20 times earnings. That's not cheap. In fact, that is expensive for stocks. If you look historically at stock market valuations before the 2000 stock market bubble, before Alan Greenspan was there artificially suppressing interest rates and blowing bubble after bubble, with each successive Fed chairman adding more pages to the same playbook, the average PE on stocks was maybe about 15 or 16 times earnings. When stocks went below 10 times earnings, that's when they were cheap. When they rose above 20 times earnings, which they did occasionally, they were expensive. That's where we are now. Now, yes, we did maintain high PEs with 0% interest rates and quantitative easing. But if you're looking at that in the rearview mirror, with the Fed hiking rates and fighting inflation, we should go back to a normal PE. We shouldn't be staying at these absurdly high valuations that were a function of monetary policy that, at least for now, no longer exists. But what's even more important than the historic PE is the fact that the E, earnings, is inflated and is going to come down. U.S. companies are not going to be able to maintain current earnings because those earnings were manufactured in an era of artificially low interest rates. Well, the ability of corporations to manufacture those earnings is gone. And in fact, as corporate debt matures and has to be rolled over at higher and higher rates, that's going to diminish corporate earnings because the interest expense is going to go up. And because so many companies are spending so much money on interest for money they borrowed in the past, they have less money to spend now. And so that also diminishes corporate earnings because they can't spend money buying the goods and services of other corporations. And consumers are going to be in the same bind. A lot of individual consumers of corporate goods and services are going to be spending a lot more interest on their own debts or paying the higher price for food, energy, insurance, healthcare, taxes. There's not going to be money left over for discretionary spending, which makes up the lion's share of corporate earnings. And so not only are stocks not cheap despite this big drop, but the earnings are about to fall through the floor, meaning stocks are even more expensive than they appear. So if we had a big down year, and as a result of a big down year, stocks were fairly valued or they were cheap, well, then maybe we'd have a rebound in the following year. But if stocks remain expensive despite a big decline, well, forget about what happened historically. I think it's far more likely that expensive stocks will continue to fall rather than rise, especially when you look at the bigger picture, which is interest rates have just risen sharply and are likely to keep rising. We have a huge inflation problem that we didn't have in other years where we had the big drop and then we had a recovery. The Fed is way behind the curve fighting an inflation problem that is going to get bigger. And it's not just the stock market that's having problems. It's the bond market. In fact, the S&P 500 had the 7th worst year ever. The total return was minus 18.1% when you include the dividends. But the bond market had the worst year ever. 10-year treasuries dropped 16%. There's never been a year where treasury bonds have fallen by 16%. And in fact, if you look at the return on the 60-40 portfolio, it was down 16.9% on the year. That is the third worst year ever for the 60-40 portfolio. And in fact, the only 2 years where investors in a 60-40 portfolio did worse than they did in 2022 was 1931 and 1937. Now, what those 2 years have in common is they fell during the Great Depression. So outside of the Great Depression, we've never had a year where investors have done so poorly on stocks and bonds. But despite the fact that we've had such a big fall in 10-year treasuries, 10-year treasury bonds remain historically expensive. As I am recording this podcast earlier today, the yield on a 10-year treasury closed at 3.8%. That is a very low yield, which means a very high price for Treasury bonds, especially when you're looking at 7 or 8% inflation. So we have a 10-year Treasury with a real yield of around -4%. And of course, the real yield is actually lower than that if you had an accurate CPI, which we don't. But even using the government's rigged CPI, which dramatically understates the effect inflation has on prices, you still have a -4% real yield on bonds. Bonds are expensive. And so bonds are likely to have another down year in 2023. And if bonds are going to have a down year in 2023, that's going to put a lot of pressure on the stock market to also have a down year in 2023. So all these analysts that are coming out and saying, well, historically, bad years are followed by good years, have no idea what they're talking about because they're not looking at all the other historic precedents that are being broken right now based on the valuations in the stock and bond market and how weak the economy is, how weak earnings are. And in fact, we're likely to start the year in a recession. In fact, I think we were in recession in 2022, but nobody wants to acknowledge that. But just about everybody who is in denial of the 2022 recession expects a recession in 2023. Yet they still expect the stock market to do well, even though we're going to be in recession. Why? Well, first, everybody expects the recession to be very mild and very shallow, and that's where they're wrong. They're right about the recession, but they're wrong about the severity and the depth. But also, one of the reasons that so many people are confident that the recession is going to be short and shallow is because they also expect the Fed to come to the rescue by going back to QE and by reversing the rate hikes with rate cuts. But even if it does that, it's not going to be a good year for U.S. stocks. It may be a good year for some U.S. stocks, but not the broader averages, in particular the NASDAQ, because these tech stocks are going a lot lower even if the Fed comes to the rescue, because it won't be able to rescue these stocks because inflation is not going to come down. In fact, when it tries to rescue the market, an already high inflation rate is going to move even higher, and that is going to hurt these high multiple tech stocks or these earningless companies, and we're going to continue to see the momentum shifting from those type of momentum stocks into value-oriented dividend-paying stocks. And in fact, if you look at the returns in 2022, I mentioned that the S&P was down 18.1%. The Dow was only down 9%. Why was that? Well, because you have more value-oriented stocks in the Dow. The Russell 2000 down 21%. Why was the Russell 2000 down more than the S&P? Well, because you have fewer value names there than in the S&P. And the index that was down the most was the NASDAQ. It was down 33%. And that's because you have that index dominated by these growth names. And those same growth names are overpriced now. And they're going to continue to fall in an environment of high inflation. And in fact, if you look at the more riskier subset of the NASDAQ, the real risky stocks, like the ones that Cathie Wood owns in the ARK Innovation ETF, that ETF was down 67% in 2022. And it closed the year 80% below its 2021 high. And even though it was down that much, and it was down again today, it was down 2.5% on the first day of trading of 2023. It's still overpriced because so many of the stocks there are overpriced. And by the way, in 2022, the ARK Innovation Fund had net inflows. Investors kept putting money into the fund despite the fact that it was down 67% on the year. So nobody threw in the towel. Nobody took their chips off the table and left. That is a negative sign, because if you're looking for capitulation, there was none. Investors kept averaging down in this fund. I think in 2023, you're going to get that capitulation. You're going to see net redemptions out of this fund. And now Cathie Wood is going to have to sell all these stocks because she's been a buyer of these stocks, even though they've been clobbered and most of her stocks are at 52-week lows. That decline came despite the fact that she's been a steady buyer all last year. So when she turns into a seller, having been the biggest buyer, look out below. A lot of these stocks are going to collapse from here. Even worse than the ARK ETF was the performance of the Grayscale Bitcoin Trust, which is also one of the holdings in the ARK ETF. But the Grayscale Bitcoin Trust finished the year down 76%. That is an enormous decline, especially if you consider that the Grayscale Bitcoin Trust was marketed as an alternative to gold, as a safe haven, as a store of value. In fact, I did a debate about 3 years ago in 2019 with Barry Silbert, the CEO of Digital Currency Group, the owner of the Grayscale Bitcoin Trust, right when that campaign first launched. When the debate began at the SALT conference, they started the debate by playing the drop gold commercial. And the whole idea was that if you own gold as an inflation hedge, as a safe haven or store of value, you should drop gold because you should buy Bitcoin instead. But not just Bitcoin, you should buy the Grayscale Bitcoin Trust. That was better than owning gold. Well, gold was actually flat on the year, maybe down a few bucks. It's hard to say. Silver was actually up about 2.5% on the year. But being flat is a whole lot better than being down 76%. In fact, I was listening on CNBC this morning to some people talking about Bitcoin, and this woman was talking about it, and she still thought that Bitcoin had some more downside because she was negative on risk assets. But then she said she thought Bitcoin would find a bottom when other risk assets bottomed out. And then later in the year, she was expecting a rally in risk assets due to the end of rate hikes and maybe even some rate cuts and a return to QE. And so she thought that that would engender a risk-on appetite, and then Bitcoin would rally with all the other risk-on stocks. And the point I want to make here is if more and more people have now accepted that Bitcoin is a risk asset, that it is not a safe haven, it is not digital gold. And by the way, Bitcoin has been reinvented every time it failed, because initially the purpose of Bitcoin was to be a currency. It was a digital currency. People were going to use it to buy coffee instead of dollars. Well, that didn't really work out very well. So they reinvented it as digital gold, because they said, hey, nobody uses gold to buy coffee either, but they use it as a store of value. And so that's what Bitcoin is going to be. It's going to be digital gold. Except that didn't work out because it really had no correlation to gold. And then for a while, they reinvented it as a non-correlated asset. Remember that? People were saying, well, the value of Bitcoin is you have no idea what it's going to do. It can go up, it can go down. It has no relationship to any other asset. And so therefore, it can be a valuable addition to your portfolio. Just it'll smooth out the volatility because it might go up when other things are going down. Except then all of a sudden people realized that it was highly correlated with risk assets and therefore provided no diversification whatsoever. It just took a risky portfolio and goosed it and made it even riskier. And so then Bitcoin became a risk asset, which is what it is now. But here's the problem. If Bitcoin is a risk asset, then what the hell is the value proposition of Bitcoin? I mean, who needs another risk asset? We got plenty of risk assets to choose from. Why Bitcoin? In fact, most risk assets have a much better risk-reward proposition than Bitcoin. I mean, first of all, what makes a risk asset versus a non-risk conservative asset? Well, a bond is generally considered conservative. Why? Because your returns are known. You loan a company money and they pay you back all the money you loaned them plus a fixed interest rate. Maybe it's 5%, maybe it's 8%, depending on the credit quality of the company. And also it depends on the anticipated inflation rate that the lender expects, because that's going to be built in to the yield curve. So the bond is considered safe because your returns are known. Now, is there some risk? Yes, you could be wrong and inflation could be higher than you think, or maybe the company isn't as solvent as you think and they go under, and so you might lose. But if the company does go bankrupt as a bondholder, you have the senior claim on the company's assets. So when the company sells off all the assets, even if there isn't enough to make the bondholders whole, maybe they'll get 90 cents on the dollar, 80 cents on the dollar. You're not going to get wiped out. It's the common stockholders that get wiped out. That's why the common stockholders, that's a risky investment when you buy common stock. Now, certain stocks are riskier than others. When you pay a higher PE, you accept a lower dividend yield because more can go wrong. And what makes stocks risky as opposed to bonds is with bonds, you know what the return is going to be. You have no idea what the return on stocks are going to be because you don't know what the company is going to earn.